Good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to start our discussion on the topic of financial planning. And we will understand what exactly do we mean by financial planning and why is financial planning so important. So, first of all, writing down the topic for today. The topic for today, as we are talking about, is financial planning. So, as the name suggests, that what exactly do we mean by financial planning and why is financial planning so important? So, when we are talking about financial planning, as the name suggests, financial planning, we are doing a certain kind of planning regarding our finances. Like, for example, we might be getting a certain salary, like some people get a fee, some people get a wage, or some people get some commissions. So, how to manage that income? So basically, I'll be using a word called income, which summarizes your fees, expenses, salaries, not expenses, fees, your salaries, your wages, your commissions, basically. So once you have received the income, your task is to do financial planning with that. You have to see that how much amount you have to spend, how much amount you have to save, how much amount, how much kind of amount you want to invest in the market, or how much amount you want to keep with yourself as liquid cash. So all these things you have to do as a part of financial planning. So financial planning involves, like, first of all, you got your salary, your income, basically. How you gonna utilize your salary? How much expenses you have? How much you gonna save? How much you gonna invest? Also, it involves future retirement planning, also your estate planning, also in which assets you have to invest in, like if you're going for the stock market and all, in which assets you have to invest in. That is whether you have to go for stock market or the commodity market, bond market, crypto market, forex market, on the basis of your risk appetite. So all these scenarios you have to take into consideration. Also, to save your tax legally, you have to do tax planning as well. Because a large number of people in India, they do not know how to save tax or how to evade, not evade, how to evade tax in a legal manner. Okay, like we talk about two terms like during tax. Like one is tax evasion and the other is tax avoidance. So one thing that you have to do is to do tax avoidance, because tax avoidance is something which is legal and tax evasion is something which people are doing in an illegal manner. That is transferring their profits and money to some countries like the Cayman Islands, like some kinds of islands in which there is a lesser amount of tax or no amount of tax, right? But you have to learn about tax avoidance, that is how to avoid your tax legally. Though, like, we'll be having a separate session for that also, like about tax planning and all. But firstly, we should understand about financial planning. So, financial planning involves everything, and I will repeat the same thing once again. For example, you got your income. How much expenses you have to pay off from that income? How much you have to save? How much you have to keep with yourself as liquid cash? How much you want to invest? Where do you want to invest? How much do you want to invest? And for what time period you want to invest? You want to invest in stock market or bond market or commodity market or forex market or crypto market or in all of these markets. How much you have to save for the purpose of the retirement, your estate planning, that once you die, your will, your estate, that how much person will be getting how much in your family members. Okay, also about the tax planning as well. So basically we can link this financial planning with something called wealth management. Right. And this financial planning comes under the context of wealth management only, because ultimately you are managing your finances, your funds, where to invest, how much to invest, how to invest, कैसे invest करना है, खुद से invest करना है, या you have to take help of the mutual funds, or you have to go for the direct stock picking. So all these things must be clear to you, like when we talk about financial planning. Okay. So I'll be presenting the PPT and we'll be trying to understand the concept of financial planning in a very easy manner. Okay, so that is the slide so which I have presented now. So it says personal financial planning. Now, financial planning can be done both from the corporate point of view and from the personal point of view. For all of those who have attended my sessions on financial management, there also I stressed upon the same point that financial management in top universities and colleges is taught from the business point of view or the corporate point of view. They talk about debt, they talk about equity and the various sources of finances, and they talk about the weighted average cost of capital, the minimum return which the capital providers must get, and so on. But no one talks about personal financial management, because ultimately, if a person is getting salary, also that person is also managing his funds. If a person is getting pocket money also, that person is also managing his funds. Similarly, the financial planning can be done both from the context of the corporate as well as from the personal point of view. Okay. But financial planning is a thing like when you talk about the corporates, again they talk about that how much debt to take, till what extent the debt to take, till what extent the debt can be risky, or like to take equity or go for the internal accruals or the retained earnings of the firm. So all that is from the corporate's point of view. But all these things that I told you just a minute back, like talking about your personal investments, your tax planning, your estate planning, so all these things involve your personal financial planning. So when we talk about financial planning, it basically denotes the process of determining whether and how an individual can meet life goals through the proper management of financial resources. So it is basically saying you have to manage your financial resources at the present day and do not delay so that you can meet your needs, your goals, your wants at a later scenario. And what can be your needs, goals, and wants? Like you want to be like plan for the retirement purposes, and you do not want to depend on anyone else, be it your family members, your children, your relatives, and you want to accumulate a sufficient corpus for that. So that you need not depend on your family members, your friends, your children, your relatives, right? So again, that can be a goal. The goal can be like your children's marriage. The goal can be your children's education. The goal can be like to buy a car, to buy a home, right? So all these scenarios can be done to meet a specific goal. Now the goal can be both a need, it can be a want, which involves the luxury items also. So certainly for all the needs, for all the purposes, ultimately you have to create a financial plan. Until and unless you don't create a financial plan, your money won't multiply and you won't be able to purchase that or enjoy that thing at a later point of time. Okay. Then it says financial planning integrates the financial planning process with the financial planning subject areas. So basically, when we talk about financial planning, there are a large number of subject areas, as I told you. Like you got your salary, how much to spend, how much to save, how much to invest, where to invest, when to invest, how to invest, tax planning and retirement planning, estate planning. So all these scenarios involve as a various subject areas of financial planning. Now it talks about financial planning. It says financial planning shall include analysis of client's current financial situation, because ultimately, before predicting your future financial situation or analyzing your future goals, the current financial situation has to be taken into consideration. So, as the second point says, identification of their financial goals. And why the first point is preceding the second point, that is identifying the client's current financial position. Because until and unless the client's current financial position is analyzed, you cannot analyze the future goals. Because, like for example, if I say that I have no liabilities with myself, okay, like I do not have to pay for some kind of loans or EMIs, be it my housing loan, my car loan, or education loan. Though I believe that housing loan and education loan are the most important loans that you should take for, if necessary. The car loan is not, because car is something that is, people call it as an asset, but I call it as a depreciating asset because it's not giving you returns. It's the value is basically going down. But the value of your house will appreciate when the real estate booms. Also, the value of your education is endless. You can increase your pay hike, you can increase your skills knowledge, like by taking a good education loan if you're going to study an MBA or a very high degree, right? So we need to see, like for example, if I say that I have no current obligations, I have no EMIs to pay off, I have no children, no kind of wife to like take care of. In that situation, I'm able to invest a larger amount at the present condition to have a huge corpus at a later condition. So that is the most non-realistic situation. But on an average, be it India or be it any other country, okay, people have an average salary of like 30 to 40,000 rupees per month, and out of that they have to pay for the EMIs as well. They have to pay for the children's educations as well. If the wife is a housewife, then you have to like pay for her expenses and needs as well. So it remains a very less amount of corpus to invest in. So it does not mean that if you are investing a very small amount of corpus, then you cannot make like crores of rupees. Still, you can make crores of rupees by having a good financial manager, or by taking advice from the other people, or simply going for like for the mutual fund scheme. Like a good mutual fund scheme, you people can search and find the alternatives from the internet. And even if you can invest just 1,000 rupees per month from the age of like 25, you people can get a corpus of like 2 crores, 3 crores, 5 crores, even like more than 50 crores as well at the time of your retirement. Okay. So basically, the thing is, before analyzing your future financial goals or what goals do you really want, you need to see the client's current financial situation, how well he is, how well he is positioned, and how much can he invest, right? Then identification of their future financial goals. Your future financial goals can be your retirement planning, it can be your child's marriage, your child's education, or maybe some any other need, some like buying a home, buying a car. So all these things can come into place also. Then developing and recommending financial strategies to realize such goals. Because obviously, if you want a certain goal to be achieved, be it your retirement planning goal or your like children's education goal, your like child's marriage goal, your children's marriage goal, not child marriage, your children's marriage goal, you have to see that how much you have to develop and recommend the financial strategies to achieve that goal. And what do I mean by the financial strategy? You cannot just invest into any of the funds in the market and say that I would be getting a certain return on that. Okay, like for example, if you are in the age of 25s or 20s, you can have a higher risk appetite, taking into consideration the other scenarios as well. Because I personally believe that age is not something which should be considered while taking the risk appetite. Because I personally have seen people who are like younger than me or who are of my age, they are risk averse. That is, they do not want to take risk in the market. Whereas the people who are at the age of 60s or 55s or 50, they are risk taking people and they still want to take the risk in the market because they kind of do not have any future liabilities and all, and they have accumulated a huge corpus. Whereas a person in 20s, why that person is acting as risk averse? By risk averse, I mean the person who is afraid from taking the risk. So while that person is afraid, he might be having a large number of responsibilities. He might be having an education loan to pay off. Like his family members might not be earning a lot and he has to sustain for them also, right? So these things can also come into place, right? So like this is one of the things that you should take care of, right? So I see, like for example, let's take an ideal scenario, like a young person having like no future responsibilities as for now, at least till the age of like 30 years, like till you have a child. Okay, so that person can invest into the equity, like 80 to 85% of the chunk can go towards the equity investment, like maybe till the age of 30 or 35 years. Starting from 40s, the person can become risk averse because at that time his goal might change to the capital preservation and fixed income. When the person was young, his goal was capital appreciation and growth. But when the person is starting to age, his goal shifts from capital appreciation to capital preservation and a fixed income, maybe in the form of dividend per month or maybe in the form of the interest income on the debt which he had purchased or like given loan to the company in the form of bonds or debentures. Okay, so these things, the portfolio churning has to be done. The portfolio has to be shifted from equity to debt or a combination of both equity and debt. Okay, so you have to say, or you basically, there are also the solution-oriented schemes as well present in the market, like which are offered by the top asset management companies. For example, you have the like we call them as a solution-oriented scheme. Like you have the retirement planning scheme, you have the child education scheme. So all these funds are available on different AMCs, be it your ICICI Bank, HDFC Bank, Kotak Securities. All these companies have customized, tailored solutions which can help you to reach your goal of what any other goal that you have, like be it for retirement, be it for accumulating a corpus for traveling, or be it for like child's education, be it for marriage, be it for buying a car, home, etc. The role of debt financing, debt counseling, and calculating debt servicing requirement of an individual, investments based on liquidity and financial goals. Because ultimately, you have to say that if you are financing something by the use of debt, by debt I mean taking a loan, then how much debt you can afford to take. And you have to take into consideration the other scenarios as well. That is, if something goes wrong with your job, like will you be able to pay off the debt as well or not? So all these scenarios have to be taken into consideration while taking debt rather than blindly taking up the debt. Debt counseling and how much debt to take, how much debt to take. Are you taking a debt for something else? Because like when a top businessman or big person take debt, they take debt for building their businesses or creating assets. But a middle class family member or a layman person takes debt for the purposes of like fulfilling his desires, like fulfilling his desires, his luxury needs, and so on. That is the difference you need to take into consideration. Are you really building your assets, or it is better otherwise? It's better for you to postpone your consumption until and unless you have that sufficient corpus with you to buy anything, be it your iPhone 13, be it your BMW or Audi, be it a large home. Okay. Then calculating the debt servicing requirement, how much debt you can pay off each month in the form of EMI. By EMI, I mean equated monthly installments, which include the proportion of both the principal amount and the interest amount. Okay. And all this has to be done on the basis of the individual's investment based on liquidity and financial goals. What goal he has and how much liquidity he wants at the present time. Because all the amount that he's earning from his income, maybe like doing a job or a business, he cannot entirely invest that 100 rupees, all of that 100% into investment. Some amount he has to keep with himself as a corpus in terms of the liquidity also. Like some kind of emergency or like contingency can come in, and that time the person requires certain money, right? Risk profiling, asset allocation, and portfolio management for different categories of individuals. As I told you, risk profiling, asset allocation, and portfolio management. That on the basis of the risk profiling, you have to do asset allocation. A person who is a risk-taking investor who wants to take more risk in the market, 80 to 85% can be allocated into the equity or into the stock market. A person who is a risk averse, who does not like to take risk in the market, and his main goal is capital preservation and not capital appreciation. His main goal is to have a fixed income and not growth of the portfolio. So that person can invest around 80 to 85 or 70 to 75 into the debt instruments. Or a person whose goal is to combine both the capital appreciation and capital preservation along with growth and fixed income. That person is a risk neutral person, and that person can invest into like both of these assets, be it like 50% equity, 50% debt, 60% equity, 40% debt, or 40% debt, 60% equity. So these things can also be done, right? When they talk about investment planning, tax planning, I told you that how to plan the investment, right? Like by creating a portfolio ultimately. So what exactly is a portfolio? Portfolio, like it comprises a large number of assets like within itself. Like for example, like instead of investing into just one stock or one industry, to diversify your portfolio by following the strategy of diversification and invested into different industries. Let me give you a very simple example. If, for example, before this COVID-19 pandemic, if anyone had invested only into the sector of hospitality or the hospitality industry, or travel and tourism, hotels, restaurants, his portfolio would have turned into negative and he would be into losses. Why? Because that person had invested only into one stock of that industry or completely into that hotel industry. Though that is also called creating a portfolio and diversification, but that's a concentrated diversification. But the true meaning of diversification and portfolio management and creation of the portfolio can only be realized when you have different sectors in your portfolio. So just assume along with the hospitality industry, the person like would have invested into the pharma sector. We all knew that how well pharma sector did in the COVID-19 pandemic. How will the IT sector or the information technology sector did in the COVID-19 pandemic? If anyone had invested like into the fast-moving consumer goods industries, your real estate industries, your like metal industry, capital goods industry, his portfolio would have balanced out. Indeed, like he would still be in positives. That is the benefit of investment planning on the basis of risk profiling and the asset allocation, while taking into consideration the creation of the portfolio. And asset allocation is nothing but how much amount you have to like invest into equity, into debt, into commodity, into forex, into crypto, into real estate, into like some physical assets. Tax planning. In order to understand tax planning, you need to know that how much tax you people can save in a legal way. You need to have knowledge about all the tax deductions, ATC, ATD, ATE, ATJ, ATTTA, ATQ. All these things must be known to you so that you can give that data to your company and avoid tax. Then again, like insurance planning, which insurance to take, how much insurance to take. So all these things also have to be taken into consideration. Retirement planning, that you must have a sufficient amount with you at the time of your retirement. Estate planning, that once you die, your will, that how much will go to how much in your family, because this creates a lot of issues like within the family members also when your will is not certain. Okay. So again, these things have to be taken into consideration while you are doing a comprehensive financial plan. Now they talk about the comprehensive financial planning. When we talk about the comprehensive financial planning, there are two approaches of financial planning. The first approach is a goal-specific planning, and the second approach is the comprehensive financial planning. The first approach is the goal-specific planning, and the second approach is the comprehensive financial planning. In a goal-specific planning, each financial goal is looked into in isolation, and a dedicated investment plan is made to realize the financial goal. Comprehensive financial planning takes a consolidated view of all the financial goals of the person. So with the definition, like one thing is clear, like when we talk about the goal specific planning, we're just taking into consideration one goal. Like for example, your goal might be retirement planning. So you are just taking into consideration the retirement goal. And you are not taking into consideration the other goals, maybe like building your house, having your own car, or having like some other items. But these things are necessary. At some point of time, you would be planning for that. At that point of time, you might fall short of cash and you might have to take loan, with something I do not prefer at all. Okay. But something is that you have to take into consideration this as well. So when they talk about this financial planning or goal specific financial planning, it is just for a certain goal and they are not taking into consideration the other scenarios as well. The second one, you have the comprehensive financial planning. It is giving you a holistic view or a consolidated view of all the financial goals of a person. Be it your retirement planning, be it your house planning, be it your car planning, your child's education, your child's marriage. So all these things are taken into consideration when you go for a comprehensive financial planning. Then it says accordingly, the investment plan too is consolidated one, not a separate one for each goal. Ultimately, in the real life scenario, also, you cannot just think of this one goal that I want to focus on my retirement and nothing else. Practically looking, you have to focus on the other important goals as well, which something is very much necessary. Okay. Then comprehensive plans are particularly helpful when the client has several financial goals. A separate financial plan for each goal can make the financial planning process very cumbersome. Comprehensive plans are particularly helpful when the client has several financial goals. A separate financial plan for each goal can make the financial planning process very cumbersome. Why? Like for example, if you go for a goal specific planning and you go to HDFC Securities, like you go to HDFC Securities and you say them that you're like one specific goal in life is retirement planning. So the person they would suggest you a retirement oriented fund. Okay, because that person has ignored the other consideration because you just said him that you want to focus on retirement planning. After that, you went to ICICI Securities and you said that person that you want planning for the purpose of buying a home. Again, it's again a goal specific planning because ultimately, like you went to some other institution and said that your only goal is to buy a home. That person will suggest your portfolio as per your goal only. So that can create problems because all these persons are working in isolation and they have no idea about the goals and all. The better scenario can be like you go to one HDFC Securities and you say that person that my goal is retirement planning. Also, my goal is to build a house or to buy a car at this stage. And accordingly, the person would suggest you the best customized portfolio, right? That is why the comprehensive plans are much easy to go with instead of having separate financial plans working in isolation with different things. Okay. Then another benefit of comprehensive plan is that investment plan across all financial goals can be made keeping the client's strategic asset allocation in mind. Stressing this point from the very first slide, keeping in mind the client's strategic asset allocation, how much the person has to invest in equity, how much the person has to invest in debt, or having a combination of equity and debt, how much to go for crypto, going for real estate, going for some physical assets, gold, commodities, all that stuff. So these things also have to taken into consideration while you are doing this. Then in comprehensive financial planning, advisors not only plan for each financial goal of the person during the earning years, but also advise on retirement planning and estate planning, right? Because ultimately your goal might not be to buy just a car or just a home. The goal might also be to have like retirement planning purpose and also for estate planning. That is deciding your will, how much in your family will get, how much for that purposes. Whew. Now, the comprehensive financial planning becomes part of the deep relationship with the client because ultimately, when you're going to a bank or talking to an asset management company, the person sitting there will be guiding you in each and every step, and some kind of rapport would be made between you and that person. That's a comprehensive financial planning. Goal specific financial planning is a good step because ultimately, see, first you can start with a goal specific plan, and certainly you can go towards a comprehensive financial plan because ultimately you get to know what exactly the person is suggesting you, and accordingly you can talk to that person and discuss your various scenarios, needs and wants in future at a particular age and time that you want. Then financial advisors enable a household to manage its personal finances efficiently in line with their short-term and long-term objectives, because ultimately if you want a certain corpus at a later date, be it for the purpose of retirement or for some any other purposes, be it child marriage, education, could be. You need to focus on your personal expenses and finances also. You'll have to cut down on your expenses and focus more towards investments. Then over a period of time, the advisor should seek to graduate to make comprehensive financial plans for the client. Ultimately, the main goal is to have a comprehensive financial plan. Be it anything, but the main goal must be to have a comprehensive financial plan. Now, personal financial analysis. So when they talk about a personal financial analysis, it is income, expenses, assets, and liabilities, and to evaluate what assets it needs, and when and how it can be funded, and what are the future implications will be on their financial situation. So basically, income, expenses, assets, and liabilities we have to see, because if I am going for the financial planning and I have a certified goal in front of me that after 20 years from now, that I am retiring and I want a sufficient corpus. So ultimately, that person who is suggesting me my portfolio will help me at how much income I have, how much expenses I have, how much assets I have, how much I can invest, how much liabilities I have to pay also. That person would be suggesting me all that. A personal financial analysis provides a holistic view of how these choices will impact the finances of household. Because ultimately, when you are investing, like in order to accumulate a sufficient corpus, you need to see what will be the impact on the present scenario as well, because you have to cut down on your expenses. Right? So that is the thing that you also have to take into consideration while doing all that. Debt counseling, insurance planning, investment planning, and asset allocation, tax planning, retirement planning, estate planning. So all these things we'll be talking about. But when they talk about your personal financial planning, they say you have to evaluate the financial position of the clients. Ultimately, the client for whom you are preparing the corpus in future or advising that client that how much you have to invest, you have to see the current financial position of that client also. But how much he can invest, what are his expenses, his EMIs, loans, and all those stuff. Preparing household budget, analysis of household budget, contingency planning. हाउस होल्ड बजट में क्या है कि तुम्हारे घर के खर्चे कितने होते हैं, घर के खर्चे तुम कैसे मैनेज कर सकते हो, दैट इज योर एनालिसिस ऑफ हाउस होल्ड बजट. Contingency planning, something wrong can happen, something contingent, even some kind of emergency can happen for which you might not be aware of. For that purpose also, like you might have some liquid cash. Estimating financial goals, what exactly are your financial goals, what role debt plays, debt should be taken or not to be taken, financial pressures from debt, because it ultimately increases your bankruptcy and it makes you a risky person if you are not able to pay off that debt. Debt counseling, calculate the debt servicing requirements, investment for liquidity and financial goals. So all these things you have to take into consideration while you are doing it. Okay. And so that's all for today. Like we'll be talking more about financial planning in the subsequent